Morning, Market Chameleons. Thanks for joining us. It is Tuesday, right, Dima? Tuesday morning,
Tuesday.
pre-market trading show.
Good morning, everybody.
Great
Thanks
to
for
see you.
being here.
Actually, I'm gonna move inside. It's rainy out where I am, so I'm gonna move inside from the outside of the American Stock Exchange.
Oh, there you go.
Inside, yeah.
Very nice.
It's like the old days, buddy. Like the old days. Before we get
That
started,
building was-
thanks for joining us, everyone. We have some new traders on asking questions. Dima, we'll get to those later. Put all your questions in the chat, like what's going on now. Remember, if you're new, subscribe to the YouTube channel. That's always a big deal for Market Chameleon and you, because you get alerted to all new videos, and thumbs up are always appreciated. With that, D, you want to start with the disclaimer?
Yep. So everyone, before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers, and we're not telling you what to do. We're just sharing ideas. If you need professional help, contact your registered investment advisor or call your broker. Your broker should be able to help answer your questions and provide you with guidance. There's the disclaimer.
Great.
And with that, let's get started. I'm going to share my screen real quick.
Awesome. Can't wait to see what you're seeing this morning.
Okay, let me see here. Don't know why this is stuck here. Well, all right, here we go. Tell me if you see my screen.
Yep, it just popped.
Okay. So we'll take a look. These are stocks that are trading actively in the pre-market hours. We got stocks most active, biggest percentage gainers, biggest percentage decliners. We'll go over a couple of them today, see what's going on. Then we'll jump to earnings, because I know we have earnings have been already coming out. We've got a lot of big companies, big tech companies that are coming out like in the next 2 weeks. So we'll take a look there. And I think also we can take a look at today some of the screeners, either the vertical spread screener, or we could take like a look at it again, come back to just the long call screener, maybe look for some seasonality plays. So that's what, at least so far, I have on the agenda. And of course, if you have questions, I'll focus on those as well. So just to take a look what's going on in the higher market cap stocks, I'm going to filter out stocks that are 20 billion market cap or higher. And let's take a look, see what's popping up. And I see UBS, I think Credit Suisse, ING, so some of the big banks, they're up on the day right now. I think what else had earnings? Procter & Gamble, couple, let me see. At least that's one that I see right now. So 13 stocks made it to the percentage gainers list in that filter, 2 on the percentage decliners. So at least so far in the morning, looks like more positive than negative breadth. Let me unfilter the list, see what's popping up top. So we got APTX, that's up 75% in the pre-market hours on 11 million shares. That's a small cap stock. Looks like they're a biotech stock. So I clicked on it. Let's take a look what's going on in this APTX. So we see here closed $3.66. The 52-week range in the stock is $1.60, high $5.28. It's trading $6.41 in pre-market hours. That's up 75% from yesterday's close, and that's making a new 52-week high. In the pre-market hours, this is its range, $5.48 to $7.93, with a pre-market VWAP of $7.14. So we're trading right now below that pre-market VWAP. 11.3 million shares trading in the pre-market hours compared to a float of 27.6 million. So on a relative basis, it's very active in the pre-market. This is what the chart looks like in the pre-market hours. So very volatile, very choppy. There is news out here, the catalyst news down here below. I'll let you guys take a look and interpret that news, see if this move is justified. Let's just take a look at it from the perspective of historical price action analysis. So I'm going to take a look at its gap history, APTX, and see how today's gap compares to historical gap moves. We're going to look at the 12 largest gap moves in the last 3 years, and then take a look at what the stock tended to do after the opening. So over here, coming down, these are the 12 largest gap moves in the last 3 years. These are the dates over here: August 7th, July 1st, May 7th. Here are the gaps in the morning. So we see the average of the last 12 gaps, 9%, with a high of, 12% right here on May 5th. So this one is way higher, way above like what we've seen in the last 3 years. Of course, they have news on there. Take a look at it, making a new 52-week high. Let's just take a look what the stock tended to do after opening up to the upside on a gap. So we see from the open to the high of the day, the average move was 7.9%. From the open to the low of the day, the average move was negative 5.5%. So a little bit more skewed towards the bullish side than bearish. From the open to the close of the day, it looks like it was down more often than up. 67% of the time it closed lower than the open, 33% higher, but the average, on average, gained 0.8%. So we see that those up moves, were much greater than the down moves in this stock. So that's really quickly a price return distribution in APTX after an opening gap to the upside. Let me take a look. What is this one? KARA. Oh, that's also small market cap stock. I thought that was the Carvana stock.
That's
do you have any?
What's that? Sorry to interrupt. I think Carvana is CRNA, or VA.
Okay. All right. Yeah. So do you have any questions on any stocks in the pre-market hours? If not, I'll try to move on so we could cover some more.
Yeah, you can move on. We do have some questions about particular stocks. They just weren't in the pre-market.
Okay. Really quickly, I'm just going to take a look at the earnings calendar and see what's going on in the morning. So this is our earnings calendar over here. So stocks that are reporting this morning, we could take a look. They'll have like a press release over here. These are the moves in the pre-market hours. So we could see like Procter & Gamble, they reported earnings. Their expected move in either direction, according to Straddle's 3% up or down. Right now it's up 1.5%. So so far within that expected range. The previous move was 2.4%. It was up. I'm going to filter this down a little bit further and look at stocks that on average trade 5,000 contracts per day, just to narrow down the list. So we could see here a couple stocks reporting: Procter & Gamble, Netflix. That's after the market closed. So Texas Instruments, they didn't report yet. Philip Morris, they reported right now up a little bit after the report. They were expecting to move 3.7% in either direction. Lockheed Martin, they're expecting to move 3.2% in either direction. So that reported to this morning, 7:30 in the morning, they issued a press release. One thing to keep in mind, see here, these conference calls. So even if they issue their earnings, that conference call could be like a second impact, right? Because once the management starts talking, once they give you what they think is going on, they give you a future outlook, some guidance, that's kind of like still, another impact to the stock. So they're going to be talking at 11 a.m. So keep that in mind, that this move could change in either direction. Snap, that's coming up after the market close. Synchrony, they reported earnings. They're expecting to move 6.2% in either direction, moving around 4% right now in the pre-market hours. So that's really quickly a snapshot what's going on.
Hey, D, from this screener, Mike McRae is on all the time, and I guess he trades a lot of weeklies.
Yeah.
He's asked before about a weekly option filter. So everyone has seen this question before. This is where he'd like it added. How could you quickly go to filter weekly options from here? Say you wanted to look at Netflix earnings opportunities on weeklies. How would you, could you walk us through how you would quickly go to it so he can see this?
Right. So, for when he's talking about weeklies, what is he trying? Did he say what he's trying to exactly filter for? Like a call option, a spread? Like, what's he looking
I think he's trying to look for the best, whatever trade ideas there are on the weeklies leading into this earnings.
So this is a calendar. This isn't looking for like a specific option that you're filtering, right? So when you're saying a weekly, then you're looking for like to trade a specific option. This is just showing you what's coming up on the calendar. But if you're like, for example, we have all these different screeners that you're screening for. So I'll just show you really quickly. Let's say you're looking for,
we'll just use, I guess, Netflix as an example. That's a big one. Or Texas Instruments, whatever.
Right. So what you would want to do is say, now remember, like when you're saying a weekly option,
he actually clarified what he's looking to do.
Okay.
So he wants to look at weekly strangles going into this earnings. Like the earnings calendar gave him the idea of these stocks. Now he wants to look at strangles in weeklies in these stocks.
Okay. So we don't have
available.
Right. We don't have a strangle screener, so we do have a straddle screener. So that'll be probably, or you could do the iron Condor.
Condor. All right.
Right, which is like selling, instead of just selling out of the money put and out of the money call, you're doing the out of the money call spread, out of the money put spread. But let's just do it from the perspective of a straddle over here. So you could just say like, earnings really quickly before expiration. So now you're looking for something with an earnings that's going to cover an expiration that's going to cover the earnings, and you could just do something like an expiration, in the next 7 days. So this, because really all you're looking for is a short dated option, right? That's what he's looking for. And when you say weeklies, some stocks do not have every week, some securities do not have options that they list every week, like SPY or QQQ, but they might have an expiration that has less than a week to go, right? So that's what you're kind of looking for. If I'm correct, he's just looking to play a move with not a lot of vega, just gamma. So this is what you would do, expiration less than 7 days to go. Here's a straddle and it covers earnings. So all these, as you could see, the earnings are coming up. These are the straddles you could do from the buy side, sell side, and see which ones have like a theoretical edge win rate. So this is already doing that analysis for you around earnings. Strangles, we don't have them. That's one screen.
He said, he actually clarified. He said, no. I want to filter stocks with upcoming earnings that have weeklies. Don't worry about the strategy. So he just wants to filter, I guess, all stocks coming this week with upcoming earnings that have within the next 7 days. And then he's going to go look at each one for, ideas for himself is what he's looking.
Yeah. Well, this is one way, right? So here's a whole list of stocks that are doing, and you could do it through any screener, right? With less than 7 days to go. Because people, when they think they're thinking weeklies, weeklies just, these are short-term dated options. That's what it means, right? They're going to expire, they're going to expire within a week. Like I said, weeklies though, when you have any other expiration with less than a week to go, it's like a weekly.
Perfect.
It's just identifying the amount of days to go.
Yeah, I think didn't we answer that in the forum? There's so much goes on every day. I'll have to go back and look at it. I thought Mike maybe put something in the forum and you answered it. But anyways, this has opened up a whole series of questions about strangles. Can you just explain why we don't have strangles, and maybe if the chameleon community is working on it for them, or is it something that may appear in the future? We're always working on stuff. So
right. So when you look at the screeners over here, we have a bunch of them. So when we started out, starting out, we're trying to create more defined risk strategies. So when you're trading a strangle, if you're just selling a call, selling a put, you really have an unlimited risk, right? I understand like people are like, well, I don't care, but you do have an unlimited risk. So the way to protect that risk is you're buying the wings outside of that, which becomes an iron condor, right? So over here, let me just show you. Like in the iron condor here. So when you're talking about a strangle, right, this is what you're doing. You're selling a put, like let's say here in Apple, the 110 put, and you're selling the call, 127.5 call. That's That's a strangle, right? But of course, if you're selling the 127 and a half call, it goes to infinity. You have unlimited risk. You're not stopped out. So the next thing, and people usually who trade strangles or even straddles over time will migrate until you take that hit, right? You're very confident until you take that hit. Eventually, if you're trading options, you're going to take that hit. I don't care who you are, you're going to take that very painful hit. So
doesn't feel so good, does it, when you take that?
It doesn't feel that good, no matter how smart you think you are or how far you analyze the options and how you're going to take that hit. And we've been in this business, smartest people, we've seen, people blow out who had so much money and eventually they took that hit. And that's the natural long-term progression, is then you start going into the more defined risk. People who sell put options, until they take that hit, then they'll migrate to like a put spread, right? So that's why when we started out, just starting it out for people, this is the strangle, right? You're selling out of the money put, out of the money call. You're protecting yourself by buying a higher out of the money call and a lower out of the money put. So now you have a defined risk. So essentially, you're kind of taking the same type of bet, but you're protecting yourself. And by the way, people who trade these know that your risk reward over a longer period of time is better doing the defined risk strategy than an undefined ahead of time. So I'm just gonna go here to the options chain. I'm gonna click on it and show you what I mean. So when I click on it, it'll take me to the option chain, populate the legs of each of these legs. And then here, I'm gonna load strategy. So you see here, look, I'm gonna expand this to 20% around. So you see here, anything goes wrong, the stock pops, whatever, I am over here. You see, I'm stopped out. So I'm stopped out. Yeah, you lose, you move on, you go to your next trade, down to the downside, you're stopped out, your risk ahead of time, you move on to the next trade, your bet is like down, up, that's somewhere in between. So I could just take a look here. Last 12 earnings, you could see these lines over here represent the percentage move in the last 12 earnings. So you see most of them, they land right here where your sweet spot is. A couple of them came out. I think there's like one that came out. So that's how you would instead of a strangle, you do a iron condor, right? Now, if you're very confident, you could just take those off, right? You could just take off the, let me see, these buys here. I'll just remove the buys. All right, I'm going to reload it. And then when I reload it, why is my computer slow?
Well, also you can build the strategy on the options chain anyways. If there was a stock coming into earnings, you could go to the weekly options in the options chain and put your
you could do it, right. Just take it off and there you go. So you get a little bit more credit, but now you got unlimited risk, right? You're not stopped out. It just keeps going and going and going. So that's why the alternative is I think it's always better to start out having your risk defined, right? How did Warren Buffett say, taking, you're not trying to knock out everyone out of the park, right? You're trying to
singles, baby. Singles win World Series, I think.
Right, singles, just keep scoring, right?
Like defense wins championships.
Right. When you're a boxer, you don't go into the ring and try to swing and just knock the person out in the first 30 seconds.
Not unless you're Mike Tyson.
Yeah, exactly. You'll tire yourself out and get knocked out yourself. So, jabs. But that's how we have it set up right now. Does that help answer his question? Hopefully.
Yeah, no, people were happy with that.
Okay. Let's take a look. Then, was there another question you had?
No, I mean, some people would like you to walk through some of, like, if there are any earnings ideas coming up, on the trading cards in the next, you mentioned Snap earnings, Netflix. I don't know if there's anything, Verizon, Abbott,
right.
BIIB, someone some people would like to see if there's anything showing up on the screeners for earnings ideas, basically.
Okay, so let's take a look over here. I'm going to see what's coming up in earnings in the next 2 weeks. Let's filter out stocks with at least 5,000 that trade on average 5,000 contracts or more. This is the next 2 weeks, full report next 2 weeks. So we see Snap coming out today after the market closed. Right now, that straddle is implying a move of 13.6% in either direction. That compares to the historical average 4-quarter move of 15.9% and historical 12-quarter average move of 17.6%. So right now we see that it is 2.3% below that 4-quarter average, 4% below the 12-quarter average. The high move in Snap here, 47.6%. So it can see a lot of volatility here.
Is that 47 or 17.6%? Am I missing? Oh,
like
47.
high move.
I
Yeah.
got
So we could take a, I mean, let me even take a look at that. Let's look at Snap real quick. So these are the historical. So these are the historical moves and the implied moves. So let me just take a look real quick at the historical moves. And when we see these bars here, these bars represent what the options were implying to move in either direction. So remember, a straddle, you're buying a call, buying a put, so you needed to move in either direction. So these are the percentage moves that the options were implying the day before earnings. These red green bars, that's the actual move to the upside. The red moves, that was the actual move to the downside. So we see here that a couple times, like over here, that's February 6th, 2018. The straddle was implying a 15% move in either direction. It was up 47.6%. So we see here that a couple times, I mean, actually a pretty decent amount of times it crashed through those expected moves. Here it just blew right out of the. So over here, if you were selling a strangle,
that would be painful.
Right, this would have been very, very, very painful. Right.
And by the way, that's that unlimited upside risk, right? That, you know, people.
Yeah. So you could see
people always worry about the tail risk to the downside. That's some, you know.
Yeah, exactly. On a leverage bet, you know, on a leverage bet where you're selling a call, you know, and you're selling it for $1. If you're buying it back for $10, it's not very pleasant. So that's why, you know, those strangles could be very painful. And you see, and you're going to see this, you know, if you're playing this game for a long time, it's inevitable. It's going to happen to you when you're taking that kind of risk. So let's just take a look from the perspective of how the predicted straddle move compared to the actual move. So we see that half the time the options overestimated the move, half the time they underestimated the move. The average of the expected moves in the last 12 quarters was up or down 15.9%. The average of the actual move was 17.6%. So you see in this situation, actually, the being long the straddles on average was more profitable than short the straddles. And of course, you had that one really huge outlier on February 6th. So that's real quickly from Snap perspective.
Hey, D, and this, I know Richard from emails, he's been around the Chameleon for a long time. He's asking what date, I mean, all these dates are exact previous earnings, right? They're after the announcement. The front I bar is showing actually what's being implied today for the next earnings move, correct?
So this October, right? This one over here, that's because we haven't yet reported their earnings. This is what's coming up now. So once we get very close to the earnings, like maybe a couple days to go, we pop up that front one just to show you what today's expectations are relative to historical.
Yeah,
so
and if you hover right over the center, it actually, I think, tells us, doesn't it? It gives us a look at what the straddle's implying. I mean, if you want to see the exact number.
Yeah, something, for some reason, I can't hover over right now. My computer's doing something, but
no worries.
yeah, but if you hover over, it let you know what the what the expected move is
Cool.
coming up. So hold on a second. Yep. Let me see why it's not.
Well, like we would tell a customer, you got to reboot your computer, my friend.
Yeah. So my computer is trying to do something right now.
Yeah. No, it happens all the time to me when I'm doing my research.
Here we go. Doing it again. All right. Why can't I catch it? All right. But in any case, you could see right here, we were just talking about it right now. I think on that report, it was predicting like a 13-point-something% move.
Yeah.
That's compared to the average moves of I think it was 15.9%.
Now, Richard is asking, Snap is today, and that is correct. I can see where Dimitri's hovering over. It says, it's a day today, and AMC down below means after the market close, right?
AMC is after the market close, BMO before the market opens. So I do get that question again. What is AMC after market close, BMO before the market opens?
But again, you as the trader have to do your research. You have to make sure, because sometimes these companies announce it's going to be before the market opens, after the market close, and
sometimes they'll change their mind. They'll pre-announce sometimes, so it's not like set in stone. They give you indications, but they can do it at any time, right? There's no rule.
Yeah. So if the vol drops significantly this morning and you think it's a great buy going into earnings, that chances are they probably pre-announced. You got to be super careful and research all the news and make sure before the market opens that you want to do this trade to play the earnings today. You better make sure that nothing's happened.
And you want to read the news and you want to pay attention, even if let's say like we were talking about this morning, they may have released earnings. They're like official press release before the market opens. But if they're going to have a conference call, at 11 a.m., well, the market open, you could trade between 9:30 and 11 a.m. And if you're selling options, but they're coming up with a conference call at 11 a.m. and it could last like an hour, you don't know what they're going to say to the analysts, and that could make the stock even reverse course, right? I've seen that a lot of times where the numbers are good or they're bad, then the CEO comes out, says something, and it just turns around the other way, and it could be just as violent from what they say. So got to just kind of pay attention to all that. Sometimes it's not even over after they release it. There's like a more news to come.
So we are getting a question about the straddle implying a 13.5%. Can you explain that 13.5% move, either up and down, what date it's to? They're kind of asking about
that. Right. So when you go to the options chain, right, you're finding and that was one of the questions, who find me the weeklies, because options, the less days they have to go, the less Vega they have. It's all priced in gamma. It's mostly just the move because you don't have enough time for Vega to come in. So right now we're looking at the nearest term options. So here, October 23rd. So if you go to, the stock close that near here, let's say, what was it? In between here, 28.5, 29. So if you take, the straddle, you click on the straddle, right? It's going to tell you, oh, man, I don't know what's going on with my computer. It just something's reloading in the background. So
it's not a problem. So Richard is asking, he's asking about the straddle. Like, is it priced off the last 10 days or last 13 moves? And he's got to be aware that straddle is pricing by the options market makers every
It'll change, right? Because we're looking at the market prices. What are the market prices pricing in? So here you got $3.94, right? That's how much the stock has to move at expiration by 3 to cover the cost of that. These are your break-even points, right? There's your break-even points, like say $4. The stock is, let's say, $29. So it's got to move from here, right, away from here by like 13.5%, 14% for you to break even. So that's the break even. It has to move more than that for you to make money on the long side. It has to move less than that if you're from the short side to make money. So
that's So other than going into how the options traders are actually pricing it, and that is the Black-Scholes or whatever model they're using, what we're seeing is where it closed yesterday, where that straddle closed, and it's the 13% to expiration, which is Friday, correct?
Right, exactly. That's how much it has to move, right? So it doesn't even matter what, if it doesn't move that much by expiration, if it's less, goes to parity, you're going to lose that premium, right? It has to move more than that for you to cover that premium. So keep in mind that the Black-Scholes model does not have a gap component, right? The binomial doesn't have a gap component. Black-Scholes, it assumes that a gap in earnings does not even exist in an option, right? It only looks at average volatility. So it just looks at if the stock closes at 100 and for it to move from 100 to 105, it has to trade all the numbers in between, right? That's why you have the normal distribution, right? Function that if it goes from 100 to 105, it has to trade at 101 penny, 102 pennies, 103 penny. It has to trade through all those prices to get from 100 to 105. So it doesn't have a gap component. That's why we only look at the straddle, the premium in the straddle to take a look at that move. Does that make sense?
Yeah, well, there you go. I mean, Richard is saying something, which is why people trade, right? He's saying, I believe that most of the move has already occurred. Well, if you do, then look at the side you want to trade. But what you said earlier, if you trade the short side of this and you're wrong and most of the move hasn't occurred, you better have traded really small, or you look to buy the wings to protect yourself.
Right. Like I said, we've been on the floor of the stock exchange and we saw people who made fortunes over 10 years. I mean, and I'm talking entire fortunes over 10 years selling options, and boom, it goes, you make a wrong move and it goes away really fast.
Well, as I mentioned to the chameleons in the chat, literally once a month, people you were standing next to in your crowd would be no longer standing there. And, it was an overnight position. They had too much of their capital invested in one position on the short side, and it took them out.
Yeah.
Well, listen, D, we have this conversation. Obviously, is almost a whole show. We should do a webinar. It's 9:30. Thanks for everyone for joining us. We got to get in front of our monitors and look for some opportunities. Thanks for all the new chameleons who asked the questions today. Join us every day during the pre-market for this show. It's lively discussion. Thanks so much, D.
Thanks, everyone. Thanks for joining us. Have a great trading day. Hope to see you guys tomorrow.